SIPs are usually touted as the magic solution for investing, but there's one thing that you really need to understand about SIPs. SIPs work best in a particular kind of market, and they work less well in a different kind of market trajectory. What am I talking about? So, what is an SIP? An SIP invests a fixed amount every month in a mutual fund. Now, because the SIP essentially staggers your investment, instead of doing it in one shot, you are investing at different points of time. Ideally, for an SIP, you need a falling market. And that's why an SIP works best when you have this kind of market, a hockey stick kind of investment trajectory, where in the period of your SIP, the market should ideally be falling and should subsequently rise. This is the ideal hockey stick, the good zone for SIPs. Now, what has happened over the past year and arguably over the past couple of years is a more or less continuously rising market, not a falling one. And so people who have done SIPs, particularly in mid and small cap funds, they have experienced not the hockey stick, but the reverse hockey stick, which is that they have bought or rather they have invested as the market has risen further and further. And so they have bought units at higher and higher prices. So in this kind of scenario with the reverse hockey stick, your average cost price actually goes up compared to what you would have got if you had done a lump sum at the very start. And afterwards, when the market falls, as it has done over the past 6 months, the SIP return is actually worse than the return you would have got by investing a lump sum amount. The SIP outcome is actually worse. Just to give you some numbers, if we use, let's say, Nippon Small Cap, India's largest small cap fund as an example, the lump sum return, the 1 year lump sum return on it is around 4%. The 1 year SIP return on it is a staggering minus 15%, 15%. Why? Because of this reverse hockey stick effect. This also holds true for 3-year periods in the same fund, but to a much lesser extent. Now, ideally, your SIP should be so long that you continue investing both in rising and falling markets, and so it doesn't matter to you whether the market follows this trajectory or it follows that trajectory. But most people, when they do SIPs, it's for 6 months, 1 year, 2 years, and they do experience this. So if this is what you're seeing in your portfolio right now, don't worry. This is just how the market is meant to behave with an SIP. If you stick with it through multiple cycles, you should be fine.